Welcome to the Financial Management module on internal controls. This module is part of a series of e-learning modules designed to foster and develop the financial management skills of people working in global health. Each module will offer an opportunity to learn from experienced managers and to engage in learning activities that are designed to apply the skills and concepts to your own professional setting. This e-learning module was produced by the University of Washington Department of Global Health, based on content from the Financial Management Essentials Handbook developed by Mango. Mango is an award-winning UK charity whose mission is to strengthen the financial management and accountability of non-governmental organizations around the world by providing innovative, high-quality in-person trainings, consultancy and recruitment services. This module provides an overview of the basic content, but not the full experience of attending one of Mango's practical and participatory training courses, where the motto is taking the fear out of finance. A library of Mango's own publications, as well as information about their services and their open training program, can be found at the Mango website. We encourage you to visit this resource of information on financial management and accountability. When you have completed this lesson, you will be able to understand the importance of introducing internal controls. You will be able to describe the principles of delegation of authority and separation of duties. Explain the importance of cash control and reconciliation. Understand ways to manage and control fixed assets and list some of the ways to detect fraud. Finally, you will be able to convey a feasible plan for managing incidences of fraud or other irregularities should they occur. When you're ready, click the forward arrow to continue. In order to best safeguard your assets, we must concern ourselves with managing internal risks facing an NGO on a day-to-day basis. This is achieved with a series of controls, checks and balances which, if operated properly, will avoid losses and detect errors and omissions in the accounting records. Controls are also very important in protecting all those who handle the financial affairs of the organization, as they remove any suspicion of or temptation to dishonesty. First, let's come to a common understanding of what internal controls are. A control is any action taken by management to manage risk and increase the likelihood that established objectives and goals will be achieved. Internal control is the collection of processes within an organization designed to provide reasonable assurance regarding the achievement of the following objectives: reliability and integrity of information, compliance with policies, plans, procedures, laws, regulations and contracts, safeguarding of assets, economical and efficient use of resources, and accomplishment of established goals and procedures. Let's now discuss the key components to internal controls. Internal control consists of 5 interrelated components: control the environment, risk assessment, control activities, information and communications, and monitoring. Each of these components is an integral part of the management process and plays a specific role in departmental internal control procedures. Let's start by discussing the first key component. A controlled environment is one of the necessary components to internal controls. Creating an environment where integrity and ethical values are expected, where there is a commitment to competence, and where there is accountability at the management level can help to assure that the environment is right for internal controls to take place and to be respected. What is included in an environment where integrity and ethical values are expected? First, the leadership must lead by example to set the ethical tone. Employees must be taught that the right thing matters. The leadership must set expectations of appropriate behavior and immediately address acts of misconduct. Finally, there must also be clear and consistent communications about the consequences of bad behavior. There must be a culture whereby there is a commitment to competence. The first element of a commitment to competence is to make sure that the right staff is hired. Second, there needs to be an investment in employee education. The third element in controlling the environment is management accountability, where management can delegate or empower employees but still maintain a firm and clear limit on authority. Additionally, there must be lines of responsibility. Conducting risk assessments is another key component of internal controls. A risk assessment is the process of identifying the barriers to the achievement of objectives and taking appropriate action. In order to conduct a risk assessment, it is first important to identify unit objectives, whether they be operational, financial, or regarding compliance. Then, answer the following questions. What could go wrong? What is the likelihood of something going wrong? And finally, what are the consequences? Then, evaluate and manage risks. What do you do with the risks? Do you eliminate, mitigate, or ignore them? Remember that risk assessment is an ongoing process. Control activities are the policies and procedures implemented by management to ensure management directives are carried out to meet organizational objectives. They are designed to address risks that could prevent achieving the organization's objectives. Control activities occur throughout the organization, at all levels and in all functions. Each organization is unique and will identify appropriate control activities to address the risks to which the organization may be exposed. Control activities include approval processes, authorizations, verifications, separation of duties, reconciliations, review of operating performance, documentation, and security of assets. For internal controls to be successful, information and communication is essential. Pertinent information must be identified, captured, and communicated in a form and time frame that enables people to carry out their responsibilities. It not only includes information systems, produced reports of operations, financial and compliance-related information, but it also includes the day-to-day communication processes among employees, supervisors, and senior management. It is also important that the information and communication flows up and down the organizational structure and flows across departments and divisions. Policies and procedures regarding the internal controls must be developed and accompanied with descriptions of roles and responsibilities. It is important to encourage and be receptive to employee suggestions. It is also necessary to have confidential reporting channels in place. And lastly, providing timely information and communication is critical. As we said, the internal controls process is constant. As such, the monitoring component is also key. A process to assess the quality of internal control systems over time is essential. Monitoring must attempt to answer the question, is the internal control system effective? It must be ongoing, integrated into other work, timely, and consistently documented. Ongoing monitoring activities include management and supervisory activities that take place every day. Either management or internal audit may undertake separate evaluations. For example, we talk about monitoring in terms of comparing actual expenses versus budgets and forecasts, or performance reviews of activities and initiatives. We also use monitoring to do reviews of unexpected results or trends and to conduct routine self-assessments and audits. Why is internal control necessary in the first place? There are many reasons, but most critically are the operational reasons and the human factor. Operationally, by having internal controls, we can safeguard assets such as staff and physical and monetary assets. By doing so, we also prevent, detect, and correct errors and irregularities, promote efficiency and cost-effectiveness, provide reliable information, ensure compliance. Other reasons to have internal controls are also related to the human factor. Internal controls protects employees, provides a documented framework within which to operate, provides checks and balances, minimizes false accusations, maintains morale. From time to time, there are arguments against internal control, including reasons such as red tape, meaning bureaucratic rules or regulations that hinder decision-making, too costly to implement, understaffed, more paperwork for record-keeping. However, the benefits of internal controls far outweigh the additional cost and workload. Who is responsible for internal control? Everybody. Management staff and auditors all have different responsibilities to assure internal control. Management holds the primary responsibility. They are responsible to design, implement, and monitor internal control. Staff holds the responsibility to operate controls, communicate problems, deviations, and impracticalities. And finally, the auditors provide their independent opinion on adequacy of internal controls. Let's discuss an example. In a simple bank account reconciliation, there are several different types of control and different players who are responsible. The account supervisor is responsible for the operating control. The finance manager is responsible for monitoring control. The director of finance is responsible for oversight control. And finally, the internal auditor is responsible for the independent assurance. Now that you know what internal controls are, why they are important, and what the key components to internal control are, let's discuss how we establish internal controls in the first place. The 4 actions of internal control is a simple way to set up your internal control systems and procedures. The first action is to direct, which is encouraging the right action. This means setting policy, giving clear instructions on who does what and what processes to follow, such as the procurement process and delegated authority. The next action is the action to prevent the wrong actions from occurring in the first place. Sometimes there will be situations where someone fails to follow the guidance in the direct stage, so we need to set up systems that will, as far as possible, minimize the risk of opportunistic theft or loss due to incompetent actions. This includes common-sense physical controls and checking actions during a process such as safes and logbooks. Next, we can detect problems by identifying if and where the system has gone wrong. We cannot prevent all incidences of loss, so we then need to have systems in place to pick these up after the process is completed and learn from it too. For example, cash counts, bank reconciliations, and internal audit. Finally, the last action is to correct errors or losses detected. This includes making insurance claims, correcting accounting records, and changing policies to reduce the chance of loss recurring. This process of learning links back to direct as guidance is updated, so completing the cycle. A good internal control system has the following elements: delegated authority or authorization, separation of duties, reconciliation and review, documentation, and the safeguarding of assets. Let's first talk about authorization, which is an important factor to consider in internal controls. Transactions should be authorized and executed by employees acting within the scope of their authority. The tasks of initiating, documenting, and authorizing a transaction should be performed by different people. You may be asking, why do we need authorization? Authorization helps prevent invalid transactions, helps ensure documentation is adequate, confirms funding is available, and confirms that other aspects of internal control are being complied with, for example, competitive quotes. Please keep these key points in mind to ensure proper authorization. Delegation of authority should be in writing. Procedures should clearly identify the extent and limit of individuals' authority to approve different types of transactions. Authorization creates accountability and responsibility. Authorization should be from at least one level above. Individuals should understand what they are approving, first-hand knowledge. Authorization should be documented. Authorization should be timely. Employees should not authorize their own transactions. Documents should proceed directly for processing after an approval and not returned to employees. Unused space should be crossed out. And blank forms and/or documents and checks should never be signed. Delegated authority is also a means of assuring internal controls. To highlight its importance, let's give an example. The Board of Trustees delegates authority through the Chief Executive for the day-to-day running of the organization. In a large and busy organization, it is not practical to expect one person to make all the decisions and authorize all transactions. The Chief Executive will, therefore, further delegate authority to members of the staff team to relieve the load and to ensure smooth operation during absences of key staff. Every organization should decide in advance who should do what in finance procedures. It is good practice to record what has been decided in a delegated authority document. Its purpose is to clarify who has the authority to make decisions, commit expenditure, and sign legal undertakings on behalf of the organization, so that there is no confusion about responsibility. The delegated authority document should include instructions for duties such as placing and authorizing orders for goods and services, signing checks, authorizing staff expenses, handling incoming cash and checks, access to the safe and petty cash, checking and authorizing accounting records, and signing legal undertaking. The delegated authority document must be approved by the board and reviewed every year to ensure it is still appropriate to current needs. It should also outline deputizing arrangements to cover for absence of key personnel. A breach of delegated authority is a serious matter and should be dealt with through the organization's disciplinary procedure. To download a sample delegated authority document, click on the attachments link located in the top right of the screen. When you are ready, click the forward button to continue. When writing a delegated authority document, there are some basic rules to observe. First, the lowest level of authority is defined. It is taken for granted that those higher up the management ladder will also have the same authority. Second, no one should authorize any transaction from which they will personally benefit. This makes the individual vulnerable to accusations of abuse. Next, the staff must not authorize payments to their managers. They must be passed to someone who is more senior in the management structure or the board. Finally, any limits or conditions that apply to delegated authority must be clearly defined. For example, a person may be authorized to commit expenditure up to a specified amount or within certain categories of expenditure or within budget. Next, let's talk about another key element of a good internal control system: separation of duties. There are a few guidelines to follow in order to assure successful and appropriate separation of duties. To start, no person should have control over a transaction from its inception to its end. Likewise, no single individual should be able to initiate, authorize, pay for, and account for a transaction, and have custody of the asset relating to the transaction. Why do we put such guidelines in place? The guidelines help to protect employees, prevent and detect intentional and unintentional errors, encourage good job performance, and provide checks and balances. In thinking about ways to successfully divide duties, please remember the following key points. Separation of duties may vary depending on size and structure of a unit or value of assets involved. Duties can be separated by department or by individuals within a department. Simple sharing of duties between individuals can often eliminate weaknesses. Management should increase their oversight and monitoring role in areas where it is difficult to have effective separation of duties. Mandatory vacation, periodic rotation of duties, and analytical review are useful management tools. Separation of duties can be circumvented by collusion, meaning a conspiracy to defraud, and the cost of a control should not normally exceed the expected benefit. In order to protect those operating the procedures and to prevent any temptation to misuse funds, there must be a separation of the various duties within the finance procedures. For example, the duties of ordering goods, receiving goods, authorizing the payment, keeping the accounting records, and reconciling the accounts should not fall entirely on the shoulders of one person. Apart from weakening financial control, this puts too much responsibility on one person, and if they should leave the organization or are absent for long periods, then the finances will grind to a halt. As far as possible, then, duties should be shared between the staff team and board members if there are only one or two staff members. Now let's look at a good example of separation of duties in a procurement procedure. A procurement procedure sets out the steps and conditions that have to be followed by staff to acquire goods and services so that the objectives of the organization can be fulfilled efficiently and effectively. The procedure will outline the process and authorities for ordering, receiving, and paying for goods and services. Describe which method of payment or acquisition is to be used for different goods and services. Clarify when it is necessary to obtain pricing quotes from suppliers, and include a list of approved contractors or suppliers if used. Each organization should have a panel of check signatories from which to select the required number of authorizing signatures. There should be sufficient people nominated to ensure efficient administration of payments. Signatories should be regularly reviewed and the list updated when people leave the organization. It is usual to have more than one signature on a check to help avoid fraud. Please note that you should never ask signatories to sign blank checks for future use, as this defeats the whole purpose of having more than one signatory. A key responsibility of managers, the chief executive or financial controller in a larger organization or a treasurer in a smaller one, is to check and authorize records, count the petty cash, and review orders for supplies from time to time. This provides an essential check on processes and is central to the concepts of separation of duties and risk management. Now that you have a better idea of what a procurement procedure is, click the forward button to learn more about the procurement process. Each organization must design a procurement procedure which suits its own circumstances. This diagram shows some typical stages in the process and demonstrates separation of duties. Step 1 is to specify goods or services to be purchased and to check the budget. The standard quantity and price of goods or services required, as described in the activity plans, is clarified so that it is clear what needs to be purchased. The amount currently available in the budget for the item to be purchased should be checked at the specification stage in case the price has changed since the budget was prepared. Step 2 is to prepare a purchase requisition. An internal request is prepared, usually on a standard form for that purpose, to formally request the purchase of the goods or services specified. The request will include a description of the purchase and state why it is required. Step 3 is to authorize purchase requisition. The purchase requisition will usually be checked and authorized by the budget holder or other nominated person to verify that there is a genuine reason for the purchase. The available budget will usually be checked again at this stage. Step 4 is to obtain pricing quotes. Quotes from reputable independent suppliers are requested in accordance with internal procedures and donor rules to make sure the organization gets best value for money and to minimize the risk of collusion. Step 5 is to select a supplier. Pricing quotes are reviewed and a supplier is selected based on price, quality, delivery times, and after-sales terms to ensure value for money. For larger purchases, it is usual to have a purchasing panel, a small group of managers who take responsibility for selecting the supplier. Step 6 is to issue a purchase order, PO. A properly authorized purchase order is sent to the selected supplier with a copy kept on file with the supplier's quotes. This is a legally binding contract. Step 7 is to receive goods from a supplier. When supplies are delivered and received, a Goods Received Note, GRN, is usually signed to confirm receipt and a copy filed for later reference. Step 8 is to receive and check the supplier invoice. The invoice should be checked and matched up with a GRN, PO, and pricing quote, usually by the finance team. Step 9 is to prepare and authorize payment. The payment authorization is attached to the invoice and all the supporting documents. It includes budget and accounting codes and must be checked and authorized by the budget holder or other nominated person. Step 10 is to pay supplier invoice. Payment should be made to the supplier within the specified payment terms, usually 30 days. Step 11 is to enter payment into the cash book. The final stage is to record the payment in the organization's books of account. Note that the procurement stages described here are for major orders, not small cash purchases. The next important element in a good internal control system is the reconciliation and review process. What is reconciliation? Reconciliation is the process of comparing accounting data to the underlying items they represent. It gives an opportunity to review, which is the inspection or examination that takes place to confirm the outcome of actions taken. It is important to conduct a reconciliation because it ensures accuracy of records, provides existence of assets, confirms controls are operating properly, and provides a mechanism for correcting errors. It is important to remember the following key points about reconciliation. It should be done on a timely basis. It can be on a sample basis. Routinely review high-risk or unusual transactions. Use source documents. Document that the reconciliation review was done. Investigate and resolve differences. Document and communicate resolution. Consider what went wrong. And finally, don't rely on reconciliation or review controls. Reconciliation involves verifying accounting records to make sure there are no errors or omissions that have gone undetected. Records that should be reconciled at regular intervals are the bank book, petty cash book, stock control records, and salaries and deductions schedules. Once the records have been successfully reconciled, the reconciliation statement must be passed on to be independently checked with the source records by a line manager or a committee member. The process may also highlight follow-up actions, for example, corrections to records. As noted earlier, this checking duty is a key responsibility of the manager or treasurer. Let's talk more about the reconciliation process. The reconciliation process will include an assessment of the bank book, petty cash book, stock records, and wages book. We will talk now about each one individually. The bank book should be reconciled to the bank statement at least once a month. This is sometimes referred to as bank reconciliation. The purpose of this exercise is to make sure that the organization's own records agree with the bank's records, which are rather like a parallel set of records. This is achieved by taking the closing bank statement balance for a particular date and comparing it to the closing bank book balance for the same date, then explain the differences. This is an important check not only for accuracy and completeness of records, but also as an early indication of fraud. To learn more about this process, please refer back to the previous module, Understanding Accounts. The petty cash should be counted and reconciled at least weekly. If the imprest system is in use, this is a very easy operation, as it is simply a matter of adding up all the payments since the last reimbursement and the remaining cash. The two totals together make up the total float. If a discrepancy is found, it must be noted in a petty cash book as either an expense unidentified or a surplus unidentified, and allocated to an appropriate category. Discrepancies must be reported to a manager. Stock records must be checked against the supplies held in the store and receipts from sales to ensure that no errors have crept in and no stock has crept out. Let's review a sample stock control sheet for some T-shirts. This table shows the value of the stock the last time it was reconciled. Then it lists new stock purchases and new sales. This gives us an expected stock value, on paper at least. Note that the table lists both the cost value, for example, what the organization paid the T-shirt supplier, and the resale value, what the organization expects to sell the T-shirts for. However, when the T-shirts in the stockroom are physically counted and checked, the actual value is less than expected. The brackets around the bottom line figures indicate the stock value is short. So what do you think might explain this difference? The difference might be caused by one of several things. The value of new purchases could be wrong. For example, the stock delivered was short. This could happen if a delivery is not properly checked against the delivery note and invoice when received from the supplier. The value of sales could be wrong. For example, the wrong amount could have been charged or a sale not recorded or coded properly. Stock could have been stolen. Or the stock could have been given out as gifts or for publicity purposes and not recorded as such in the accounts. Whatever the explanation, the difference has to be investigated and systems reviewed if necessary. This example demonstrates the importance of regular stock checks. And lastly, the wages records, and particularly deduction records, are notorious for containing inaccuracies and for abuse in the form of ghost employees, for example, people on the payroll who do not exist, and where a salary is paid and collected by someone committing fraud. Wages records must be reconciled every month to ensure that the correct deductions are being made and passed on to the relevant authority. Failure to do so could result in severe penalties and interest being imposed, and cause discontent among the staff. Thus far, we have discussed how to set up and maintain a system of internal control. Let's now discuss the importance of documentation. First of all, transactions should be clearly and thoroughly documented, and documentation supporting each transaction should be available for review. But why should we be concerned with documentation? Documents provide a record of what happened. Documenting details increases the likelihood of an accurate and complete transaction. Documentation avoids disruption of activities when employees are absent or when there is staff turnover. Documentation also provides a mechanism for other aspects of internal control to take place. There are a few key points to remember when thinking about the importance of documentation. Documentation should provide clear evidence of what happened, who initiated, who approved. Documentation should be prepared at the time the transaction takes place. Corrections should be made in pen and with an initial to appropriately make document changes. Attach an email or memo to documents if necessary. Do not use whiteout, pencil, or post-its. Key documents should be sequentially numbered. Voided or spoiled documents should be retained. Documentation is the organization's property and therefore is subject to appropriate level of security. Be sure to use placeholders when removing documents from file or storage. And lastly, be aware of retention requirements. We also want to take care to document the system. Internal control systems should also be documented and have a policy for amendments to the system. Documenting the system promotes consistency, avoids disruption when employees are absent or during staff turnover, and outlines authority and responsibility of employees. One of the aims of internal controls is to safeguard assets. All assets of the organization should be kept secure at all times to prevent unauthorized access, loss, or damage. Remember that assets can be physical, human, paper, information, or electronic. We use safeguards to protect assets and records from unauthorized use, loss, or theft. This helps to ensure organizations can continue to function, avoids costly and time-consuming recreation of assets, and creates compliance with document retention and reporting requirements. As you work towards safeguarding assets, please remember the following key points. Assets and records should be accessible only to authorized employees. Specific individuals should be assigned responsibility for custody of assets. Greater security for liquid assets, for example, cash. Consider physical access controls. Consider what documents and/or assets need to be in lockable, fireproof, waterproof storage. Consider insurance. And have a check-out process for separating employees. Now that you have an understanding of the importance of safeguarding assets, click the forward button to learn more about common rules for handling cash. It is important to observe the 7 golden rules for handling cash. 1. Keep money coming in separate from money going out. Never put cash received into the petty cash box. It will lead to error and confusion in the accounting records. All money coming into the organization must be paid into the bank promptly and entered into the records before it is paid out again. Failure to do so will distort financial information. 2. Always give receipts for money received. This affords protection to the person receiving the money and assures the person handing it over that it is being properly accounted for. Receipts must be written in ink, not pencil, and preferably from a numbered receipt book. 3. Always obtain receipts for money paid out. Sometimes this may not be possible, for example, when purchasing materials from a market. In this case, the cost of each transaction should be noted down straight away so that the amounts are not forgotten, and these can then be transferred to a petty cash slip and authorized by a line manager. Remember, without a receipt, you have no proof that the purchase was made. 4. Pay surplus cash into the bank. Having cash lying around in the office is a temptation to a thief, and the money would be better managed if it were earning interest in a bank account. A casual approach to cash on the premises might also lead to people wanting to borrow from it. Many a sorry tale of fraud has started in this way. You should always aim to deposit cash into the bank on a daily basis or, at the very least, within 3 days of receipt. 5. Have properly laid down procedures for receiving cash. To protect those handling money, there should always be 2 people present when opening cash collection boxes, etc. Both should count the cash and sign the receipt. 6. Restrict access to petty cash and the safe. Keys to the petty cash box and the safe should be given only to authorized individuals. This should be recorded in the organization's delegated authority document. 7. Petty cash should only be used to make payments when all other methods are inappropriate. Wherever possible, suppliers' accounts should be set up and invoices paid by check. The advantage of paying for most transactions by check is that this has the effect of producing a parallel set of accounts in the form of the bank statement. Also, it ensures that only authorized people make payments, and it reduces the likelihood of theft or fraud. In addition to having controls around the cash, it is also important to have physical controls in place. Physical controls are additional common-sense precautions taken to safeguard the assets of an organization. Having a safe or a safe place to keep cash, checkbooks, legal documents, etc. is an important consideration. A proper safe is worth considering, especially if your organization has to keep large sums of money on the premises overnight. Safes are, however, expensive, and if resources are tight, then it may be better to improve on banking procedures. Ensuring adequate insurance is an important responsibility of the chief executive, so that if assets are lost, damaged, or stolen, they can be replaced or compensated. There are many different types of insurance to consider, including office contents against fire and theft, buildings against fire, floor, and storm damage, vehicles against accident and theft. The decision whether or not to insure property is a good example of managing risk. Weighing the pros and cons of paying for insurance is a common dilemma for managers. Fixed assets may represent considerable wealth held in the form of land, buildings, vehicles, machinery, and office equipment, and require special attention to ensure their value is maintained and that they do not disappear through lack of vigilance. The measures to safeguard these assets will include assets register, a vehicle policy, and maintenance policies for equipment. Let's discuss in more detail a bit more about the assets register. An assets register should be established with an entry or record sheet for each item. Each asset should be tagged with a unique reference number for identification purposes. The register will record important information about each asset, such as where and when the item was purchased and how much it costs, where it is held or located, how much it is insured for, maintenance history, serial numbers, details of guarantees or warranties, and depreciation rate and method where relevant. The record sheet should also state who is responsible for its maintenance and security. The assets register should be checked by a senior manager or committee member every quarter, and any discrepancies should be reported and appropriate action taken. To preserve the value of buildings and equipment, an organization must have an active policy of building and equipment maintenance. For buildings, this may require a professional planned maintenance contract for which a realistic budget must be provided. Office equipment such as photocopiers and electrical equipment should also receive regular services by qualified technicians to ensure they are safe and operating properly. Every organization that owns vehicles should have a vehicle policy. This will set down the policy on a range of issues such as depreciation, insurance, purchasing, replacement and disposal, maintenance and repair, private use of vehicles by staff, what to do when accidents happen, driver qualifications and training, and carrying of passengers. The costs of repair and replacement must also be adequately reflected in the budget process. For each vehicle, there should be a trip log so that the running costs per mile can be assessed and private use closely monitored. Once you have 12 months information on the costs of running a vehicle, it is possible to calculate its average running costs per mile. To download a sample vehicle log sheet, click the attachments link above. In addition to physical security and cache security, it is critical to address information systems security. Information systems security addresses the fact that information stored and sent via computer is at risk of disclosure or modification. The confidentiality and sensitivity of the data should be assessed to determine what controls should be in place to protect the information, and that copies of data should be maintained on storage devices separate from the computer. Why is information systems security important? Because portability of data increases risk. Size of storage devices increases risk. Because confidential information is sensitive, and it is important to ensure compliance with privacy regulations. Organizations should have a systems security policy so that all providers and users of the organization's computing services, resources, and data are in full compliance with all established guidelines and procedures, including applicable federal statutes and regulations. Keep these key points of information systems security in mind. It is important to understand the nature of the data generated and used, and to store and manage data in compliance with records management and retention policies. Also consider the physical location of computers. Computer systems should always be physically secured to protect damage or theft. In addition, there are some access controls for information systems security that should be kept in mind. There should be a method to identify persons authorized to access data, and ensure only authorized persons obtain such access. Computer systems should require a person identify themselves via information only they know, for example, a user identification and confidential password, and close all accounts and remove all access capabilities related to separated employees. User data access privileges can be used to support other aspects of internal controls, including the segregation of duties, protection of assets, and transaction authorization. There is also a level of systems and network security that should be adhered to. Systems should be protected by antivirus software. All data and system files should be regularly backed up to another physical device and stored in a separate secure location. The organization should maintain a minimum data security standards, which describe the minimum standards the organization will strive to achieve in appropriate circumstances to limit access to and to limit the distribution and disclosure of electronic information. The security standards should provide definition of the following data categories: public, restricted, and confidential. Protective measures or controls that should be implemented for each category are access control measures, implementation of access logging and alerting, levels of user authentication to access data, requirements for network firewalls, data and system backup and recovery requirements, data encryption, and when data is transmitted. From time to time, internal controls can break down. They often break down for the following reasons: wrong tone among management. Managers behave as if they are above the rules. Lack of ownership or responsibility, not my problem. Lack of communication, training, experience, skills. Poor system and controls to start with. Collusion, meaning a secret agreement or cooperation for illegal or deceitful purpose. Understaffed, overworked, mistreated, ignored employees, perceived or actual. The belief that controls are too costly and decide to accept the risk. Over-reliance of trusted employees, and errors in judgment and actions. There will be occasions when internal control systems fail to prevent losses through theft, fraud, or other irregularities. Fraud is intentionally lying or cheating to gain an advantage or to cause someone else to make a loss. Fraud includes theft of goods or property, falsifying expenses claims, and falsification or destruction of records to conceal an improper action. Fraud does not include accounting errors, actions condoned by established practice, and cases where no loss is incurred. Irregularities include unauthorized activities for private gain. For example, borrowing from petty cash, use of vehicles, or abuse of telephones or other equipment. Inevitably, the impact of fraud has a damaging effect on the organization. Imagine a stone falling into a pond. The initial splash is the loss of funds or equipment, but it does not stop there. There will be extra work for managers and activities delayed, which in turn may cause staff morale to suffer, beneficiaries to lose out, and an organization's credibility to suffer. Ultimately, this can cause funding to be withdrawn, organization objectives will be unfulfilled, and their survival to be under threat. Now that you have a better understanding of the causes of internal control breakdown and how to recognize fraud and other irregularities, click the forward button to learn about the steps you can take for managing incidences of fraud. Incidents of fraud and irregularities require sensitive handling to minimize the long-term impact. It is important to be prepared to deal with any occurrences of fraud or financial irregularity by having a written procedure which covers steps that need to be taken. Deterrence. The procedure should state clearly that routine controls, checks and balances are in place to safeguard the assets of the organization and to protect staff from any suspicion of or temptation to fraud or other impropriety. Paid staff and volunteers are therefore obliged to cooperate fully with internal control procedures, and failure to do so will be dealt with as appropriate with the organization's disciplinary code. The procedure should also identify different types of irregularity, how seriously they are viewed, and how they will be dealt with. For example, all instances of theft and fraud will be viewed as gross misconduct and will result in immediate dismissal and loss of terminal benefits. A clear statement of the organization's policy on the circumstances in which the police will be informed must also be made. This must take in account local circumstances. Detection. A procedure for reporting suspicions of irregularities should be made clear to all. This should make it easy for people to report concerns in confidence and without fear of retribution. When an irregularity is reported or detected, record the details in writing. Report it immediately to a superior. Follow up all reports or suspicions immediately and do not allow rumors to spread or let the trail go cold. Investigation. When an irregularity comes to light, it must be dealt with quickly and sensitively. Look for corroboratory evidence before instigating a formal investigation. If all the evidence points to an irregularity, the individual or individuals involved should be formally interviewed with a third person present to take notes. Protect documents and records by either removing access to them by those involved in the irregularity or by suspending the people involved during the investigation. The policy will identify who is responsible for conducting a formal investigation. This will depend on the nature of the irregularity. It could be conducted by the senior manager, the internal auditor, the external auditor, or, in more serious cases, the police. The aftermath. Don't underestimate the long-term and less tangible impacts of fraud. It will involve a lot of managers' time during the investigation and afterwards. In particular, people will be distressed by the experience and may need to be supported. Colleagues will suffer all the mixed emotions of bereavement, anger, guilt, disappointment, and loss. They will be worried that their own jobs are under threat. New staff may need to be recruited and trained. Donors will need reassuring that their resources are safe and the project will not suffer. Of course, preventing fraud is always preferable to dealing with it after it occurs. The following ideas may be an early indication of fraud or abuse. Use with caution. From the accounting records, lots of corrections to the manual cash book. This may include extensive use of whiteout or blocked-out figures. The opposite can be an indication of fraud too. Pristine records, for example, a manual cash book that looks as if they have all been written on the same day in the same handwriting, could be an indication of rewritten or duplicate books. Delayed banking of cash received, shown up by bank reconciliation, could be teaming and lading, a method of allocating customer payments to another in order to make the books balance to detract from a possible shortfall. Records not being kept up to date. For example, deliberately delaying records so managers cannot detect false accounting going on. Missing supporting documents. For example, certain bank statements destroyed to cover someone's tracks, or a project officer who regularly claims to have lost receipts. Debtors rising unexpectedly. For example, if debtors have paid but the cash is being pocketed. This may occur if there are poor controls in issuing receipt books, as someone could take an unused book and issue valid receipts without them ever being entered into the accounting records. Handwritten supporting documents with errors and corrections on them. This indicates possible changes made after the goods or services were purchased. And cash counts not reconciling to the accounts, but reconciling at the next cash count. This indicates possible borrowing of funds by the custodian of the safe. Fraud can be picked up on by examining the reports. Budget monitoring reports showing inconsistent behavior between line items. For example, project-related expenditure is underspent due to delays, except for fuel, which is overspent. This could indicate abuse of vehicle usage. Vehicle logbooks not maintained in an appropriate level of detail. This could indicate abuse of the vehicle as well. Budget monitoring reports delayed, to possibly cover something up. There are also non-financial areas to be attentive to. An employee working very long hours, coming in early and leaving late, may be doing extra work to cover up signs of fraud. An employee never taking holidays, so no one else could detect what they are doing. A sudden change of lifestyle. For example, an employee's spending patterns don't match their income. They are suddenly wearing designer clothes, have changed social habits, or even driving an expensive car. Employees creating smoke screens, where someone is making a false accusation about another team member to give them time to cover their tracks. As mentioned, preventing fraud is better than dealing with it once it occurs. Here are some ideas on fraud prevention. Make sure you have robust internal control systems in place. Visit projects and see if the activities carried out roughly match the expenditure. Share financial reports with beneficiaries and ask if they feel they have had value for money. Hold regular meetings with other staff at all levels, for example, project and administrative staff, board members, etc., to discuss financial reports and to make budgets and reports openly available. And lastly, help non-finance staff and managers improve their financial skills. As a way to recap what we have learned today, here are some tips on how to deal with fraud and other irregularities to keep risks low. This helpful mnemonic can help remind you of the steps towards dealing with fraud and establishing internal controls. Do report the incident to a supervisor or board member. Investigate incidences and gather the facts. Secure the assets and records. Keep calm. Swiftly act. Don't look the other way. Don't overlook the fallout of a fraud, and don't withhold information to protect others. As we mentioned, it is better to prevent fraud than to deal with it after it has occurred. A good internal control system includes adequate separation of duties, transactions clearly and accurately documented and available for review, transactions authorized by persons holding the appropriate delegated authority, and appropriate reconciliation and review procedures. The design of internal controls will depend on size of the organization, complexity, value and volume of transactions, risk analysis, the degree to which the organization is centralized or decentralized, and the source of funding. Here are a few reminders about what we discussed as tips for creating a system of internal control. Identify the function, activity, or transaction. Document your understanding of the system. Identify the internal control objective. Determine the risk, errors, fraud, or non-compliance. Determine level of risk tolerance. Evaluate current internal controls. Decide on whether new controls are needed. Document and communicate. And monitor by obtaining feedback and evaluating the effectiveness of new controls. To recap what we covered in today's lesson, you should now have a better understanding of the importance of internal controls. Describe the principles of delegation of authority and separation of duties. Explain the importance of cash control and reconciliation. Understand ways to manage and control fixed assets. Today, you learned ways to detect fraud and should now be able to convey a plan for managing incidences of fraud or other irregularities. Congratulations! You have reached the end of the module. Please take this time to revisit any of the content we covered today. When you are ready, click the Home button to return to the main menu.